Hello, Marc Ostwald from ADM Investor Services International, with some thoughts this week following on from the plenum in China of the Communist Party, and obviously as we await the US presidential election next week, and looking also in the context of some of the volatility we've seen, particularly in equity markets over the week. So I think sometimes we always need to step back a little from the immediate market and have a look how things look in a longer term context. So this week's charts are mostly five-year charts, just to put things in context. And the first one is the MOVE US Treasury Volatility Index. This sort of moves on from last week's recording, in which I was talking about the steepening of the US yield curve. And as one can see on that chart, we have seen a rise in US Treasury volatility, but by any comparable measure, we are still basically in the range that pre-existed the pandemic, and basically just getting away from the extraordinarily low levels of volatility that we saw, particularly during the summer months after we got markets back under control. The second chart is comparing the VIX Volatility Index on the S&P 500 and the Deutsche Bank CVIX Foreign Exchange Volatility Index. And I think this is interesting insofar as the VIX, which is the green line on the chart, has started to pick up again. I think that's a measure of volatility is likely to remain fairly sustained at a higher level until we actually get some clarity on the US election result. There is little doubt that as far as markets are concerned, it's not a question of preferable outcomes of who wins, but the preferable outcome is that it's not a long, drawn-out, protracted process with endless recounts and or legal challenges. But we've picked up. But again, if we look at this in a longer-term context, currency volatility is really just a little bit elevated, but nothing tragic relative to what we saw back at the end of Q1. And the same applies actually to the S&P 500, though clearly we are establishing a much higher range than pre-existed the pandemic. My third chart then moves on sort of in a natural way to what's been going on in the currency markets, because I think this is potentially quite significant post the election. First of all, we've got the US trade-weighted dollar index. As one can see, it's had a long uptrend back until the middle of 2020, and it's come under some pressure. And there's no doubt about it, that is basically because we've got pretty much level interest rates across the world. Nevertheless, the dollar still has the support of the fact that it is the world's funding currency, and those talking it out of its reserve status do need to remember that the world is naturally short of dollars. The more interesting one I personally find is the fact that we've seen a significant move higher in China's CFETS Index, and it was announced this week that China is basically abandoning some of the measures to bring it back into line with the index. And I think that probably is something to do with the fact that as they reposition their economy to be much more self-dependent, it is in their interest actually probably to let the yuan appreciate a little bit more, both to encourage its international use with its, particularly with its counterparts in Asia. And secondly, from the point of view that if it's not quite so export dependent in terms of its economy as it repositions itself, so it's more in its interest to have cheaper imports, and that can be certainly helped by a somewhat stronger yuan. But there's also another aspect, and this is my final chart for today, and that is how we've seen a marked widening in Chinese spreads, not only over the US, which is this, but also everyone else, and that underpins the yuan, and there's no question about that. Something to think about as we go forward.